How's it going, everyone? Welcome back. Or if this is your first time here, my name is Edgar and this channel is about personal finance, real estate investing, stock market investing, and personal development. So if that is something you want to learn about, make sure you are subscribed. Today we're going to be talking about how you can take your stock portfolio from $100 and grow it to $10,000 and then to $100,000 and eventually have a stock portfolio that is worth over $1 million. When you are a new investor, investing can seem very difficult because there are many different factors that you have to consider. There's thousands of stocks that you can pick from. Then each one of those companies is going to have their own numbers and ratios, and one ratio might be good for one company but bad for another one. Plus, you also have all these financial statements and many other factors, which makes investing seem very complicated and even risky. And even though investing may not be the easiest thing you've ever done, it's not as complicated as many people think, and you do not have to be a Wall Street expert to make money by investing. Also, when it comes to investing, many people think you must have thousands of dollars to begin investing, and that is just not true. Nowadays, you can open a trading account with $0 and you can begin investing with only a few dollars. So even if you only have $20 right now to begin investing, that is enough, and you should not wait because there will always be a reason why you cannot begin investing right now. And at the end of the day, you cannot grow your stock portfolio to $10,000, $100,000, or even $1 million if you do not begin investing in the first place. So with that in mind, let's go over the first thing you should know when you're just getting started with investing, and that is you should not look at investing as a way to get rich overnight. Even though investing will get you to the point of being wealthy and financially independent, it will not happen overnight, especially when you're just getting started. For example, if you start investing with $100, even if you achieve a 100% rate of return, you will only have $200. And even though it is possible to achieve a 100% rate of return, you should not begin investing expecting that every investment you make will have a high rate of return. Also, whenever you invest with the intention of becoming rich overnight, you will be more likely to fall victim to various scams. I mean, there's always going to be people who claim they found the next Amazon or the next Apple, and they try to sell you on these stocks by telling you this stock is going to double, triple, or even quadruple in price in the short term. And by buying this stock right now, you will be one of those early investors, which means you will have the chance to make huge amounts of money. And someone who began investing with the idea that they will become rich overnight is more likely to fall into this trap. Or something else that is very common when people are just getting started with investing is they see advertisements of people who claim they began with just a few $1,000s and they turn that into millions of dollars. And whether that is true or not is not really the point. The point is that they will try to sell you courses on how to trade and how they made all their money. So people end up spending hundreds of dollars on these courses thinking that will somehow be the key to making a ton of money. But the thing is, the information they are selling you is information you can find somewhere else and for free. So instead of spending your money on these courses, you would be way better off taking that money and beginning to invest. I mean, the only way you will be able to grow your stock portfolio is if you take the first step and make the initial investment. Because if your stock portfolio is at zero, then there is no way you can grow it without making some initial investment. However, if the reason you're putting off investing is because you are scared that your investment will go down in value and that you will lose money, then you shouldn't use that as an excuse not to invest. Yes, investing always carries some level of risk, but there are many ways you can invest to limit the odds of losing money. For example, let's say you are someone who is just getting started with investing, so you don't know what to look for when you're deciding what stocks to invest in, and because of that, you're scared of losing money. In that case, you can still invest in the stock market, but instead of investing in individual stocks, you invest into ETFs. And for those who are not familiar with what an ETF is, it stands for Exchange Traded Fund, and this is a basket of securities that are made up of different asset classes like stocks, bonds, commodities, and a few others. And the purpose of these is to allow you to have exposure to these investments, but at the same time they provide diversification, so the odds you will lose your entire investment is very small. So if you're someone who has wanted to begin investing but you haven't done so because you're scared of losing money, then just begin investing in ETFs until you become more experienced with researching individual stocks. And then at that point, you can begin investing in stocks like Visa, Apple, Facebook, and all those other companies. But again, the point is you begin investing because you will never grow a stock portfolio unless you take the first step and begin investing. So once you've taken the first step, the next thing you will have to do is establish a routine for making additional investments, and this could be every week, every 2 weeks, or every month. And how often you make additional deposits into your account isn't as important as getting into the habit of making additional contributions. Now, the reason why you must get into the habit of making additional contributions into your account is because the more you can invest, the faster your stock portfolio will grow, and the more it grows, the more you benefit from compound interest. For example, let's say you start off your stock portfolio with an investment of $100 and you're able to achieve a rate of return of 10%. If you never make another contribution, it will take you 46 years to grow your stock portfolio from $100 to $10,000. However, if you begin your stock portfolio with the same $100 and you still have a rate of return of 10%, but now you invest $100 every week, it will only take you about 2 years to grow your stock portfolio from $100 to $10,000. So as you can see from these two examples, when you continue investing, your stock portfolio will begin to grow at a much faster rate than if you only make one initial investment or you only invest every now and then. Now, I understand not everyone is going to be able to invest $100 every week, but the point of using $100 was to show you the difference between someone who makes constant investments versus someone who doesn't. So with that in mind, you want to get into a habit of investing a certain amount every week, every month, or every time you get paid, even if it's only $20, because even small amounts add up to large amounts. But more importantly, this will get you into a habit of investing, and then when you begin earning more, you can begin investing more. And at this point, it will be easy to invest a certain amount of your income because you already built a habit of investing. Now, the next thing that will help you grow your stock portfolio is reinvesting any dividends you are paid. Earlier, I showed you the difference between someone who invests every week and someone who only makes one investment every now and then, and how much faster your portfolio will grow if you make constant investments. Well, the same is true when it comes to reinvesting your dividends, because whenever you use your dividends to buy more stock, your portfolio will grow much faster than someone who does not reinvest their dividends, and this is because of compound interest. Now, when you're just getting started and you only have $100 or even a few $100 in your portfolio, then you won't be receiving much money in dividends because the amount of stock you own is so small, so there's no point in even trying to cash out any dividends. I mean, a portfolio of less than $1,000 might only provide a few cents in dividends, if any, because remember, not all companies will pay a dividend. So if the stocks you have in your portfolio do not pay a dividend, then you don't have anything to reinvest. However, if you are receiving dividends, no matter how much you are receiving, you should get into a habit of reinvesting them because even small amounts add up. But beyond that, you want to get into a habit of reinvesting dividends, so that way when your portfolio begins to grow and you begin earning more dividends, you are already in the habit of reinvesting them. And this is when they will begin to make a big difference in how fast your portfolio continues growing. Now, when it comes to reinvesting your dividends, you have a few options on how you can do that, and the most common way is by reinvesting back into the stock that paid the dividend in the first place. For example, let's say you own some Visa stock and they paid you a dividend. One way you can reinvest those dividends is by using them to buy more Visa stock. Or another option that is available is taking those dividends and reinvesting them into a different stock. So let's say you own Visa, Wells Fargo, and Avalon Bay Communities, and Visa paid you a dividend. Well, you have the option of investing your dividends into Avalon Bay Communities or Wells Fargo stock, and the reason you would do this is to maintain your allocation at a certain balance. So to keep this example simple, let's say your entire portfolio is made up of 3 stocks, Visa, Wells Fargo, and Avalon Bay Communities, and when you first invested into these stocks, you had an even allocation across all 3 stocks. So that means each stock made up 33% of your portfolio. But now Visa has increased in price more than the other 2 stocks. So now Visa makes up 40% of your portfolio, and Avalon Bay Communities and Wells Fargo each make up 30%. Well, in order to maintain an even allocation across all your stocks, you would take the Visa dividends and reinvest them into Avalon Bay Communities or Wells Fargo stock, and that would help get your allocation back to where you want it. And when it comes to how you reinvest your dividends, that is pretty easy because most, if not all, brokerages will ask you if you would like to reinvest your dividends when you first buy the stock, and once you select yes, they will automatically reinvest your dividends. However, when you do it this way, they will reinvest your dividends back into the stock that paid the dividend in the first place. So if you want to reinvest back into another stock, then you will have to do that separately. And depending on what brokerage you are using, it may be different for everyone, so just keep that in mind. Also, something else I should mention when it comes to reinvesting dividends is that it is possible that at some point you will no longer reinvest dividends because instead you will be using those dividends to pay for your kids' college education, to fund your retirement, or for something else, and that is fine. So if you're someone who is still many years away from retirement and you don't have any kids who are going to college soon, then you could focus most of your investments in assets that have the potential for increasing in value by large amounts, versus putting most of your money in blue chip stocks which are more stable and pay more in dividends. Now, the next piece of advice when it comes to growing your stock portfolio is you should avoid selling your stock and cashing out until you have a big enough portfolio that withdrawing a few $1,000s isn't going to make much of a difference. For example, if your portfolio is at $3,000 and you sell $2,000 worth of stock so you can take a 2-week long vacation, then it's going to take a lot of effort to get your portfolio back to where you were, and it's going to take you even longer to get it to $10,000. Now compare that to someone who has a portfolio that is worth $100,000. If they were to sell $2,000 worth of stock to take a vacation, then their portfolio is now at $98,000, and it wouldn't be very hard to get it back to $100,000. And just to make my point clear, let's look at what kind of rate of return both of these people would need to get their portfolio back to where it was before they sold any stock. So the person who has a portfolio that is worth $3,000 and sold $2,000 worth of stock would need a rate of return of 300% to get their portfolio back to where they had it. Now the person who has a portfolio of $100,000 and also sold $2,000 worth of stock would only need a rate of return of about 2% to get back to where they were. So if your portfolio is still on the small side, then you should avoid selling any of your stock unless you plan on selling one stock to buy another. So with that being said, this is my advice for someone who is looking to grow a small portfolio, and it doesn't matter if your portfolio is at $100, $1,000, or even $10,000. The process of taking your portfolio to the next level is all the same, and the only thing that changes are the numbers. So with that being said, if you enjoyed this video or you found this information helpful, it would really help me out if you hit the like button and subscribe. Thanks for watching, and I will see you next time.